Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. Later on, we'll be talking with Sang Lee. Sang Lee is the Chief Executive Officer of DarcMatter. That's all one word, spelled DarcMatter, a transactional platform which offers institutional-level access to alternative investment opportunities. But first, let's talk about booze, which may be an investment opportunity. We'll see that in some senses it has been. Anyway, the MarketWatch.com published an article on February 3rd, 2015 by Charles Passy, entitled Millennials Are Choosing Bourbon Over Budweiser. The article went on to say nothing about millennials, but the general trend is very much in favor of bourbon and Tennessee whiskey and against beer, especially Budweiser. Beer sales have been on a decline, reports Mr. Passy. They're down 4% over the last 5 years. Domestic sales of Budweiser, in particular, are down a catastrophic 28% over the past 5 years. According to the Distilled Spirits Council of the United States, sales of bourbon and Tennessee whiskey, which is a type of bourbon, soared by 7.4% in 2014. Overall spirit sales increased by 2.2%, and bourbon and Tennessee whiskey rose faster than single malt scotch, tequila, and vodka. The reference to Tennessee whiskey, of course, reminded me of the George Jones #2 hit from 1983 entitled Tennessee Whiskey. And here are the key lyrics. I will not sing them, but here they are. You're as smooth as Tennessee whiskey. You're as sweet as strawberry wine. You're as warm as a glass of brandy. And I stay stoned on your love all the time. Those of you who are getting married, you might use those in your wedding vows. Another poetic turn on the theme of bourbon was offered by Walker Percy many years ago. Walker Percy won the National Book Award for fiction for his splendid 1961 book, The Moviegoer. And he wrote an essay entitled Bourbon Neat about the aesthetic of bourbon drinking in general, and in particular, knocking it back neat. Walker Percy was a doctor. He spends a little time talking about the effect of ethanol on the cortex, but he spends more time talking about the little explosion of Kentucky, USA sunshine in the cavity of the nasopharynx, and then still more time on how bourbon did for him what the piece of cake did for Proust. And so here are a few memories, which I like, so I'll share them with you. And I'm going to read from the essay. 1934. Drinking at a Delta dance, the boys in bi-swing jackets and tab collars, tough-talking and profane and also scared of girls and therefore safe in the men's room. Somebody passes around bootleg bourbon in a Coke bottle. It's awful. Tears start from eyes. Faces turn red. Hot damn, that's good. 1935. Drinking at a football game in college, UNC versus Duke. One has a blind date. One is lucky. She is beautiful. Her clothes are the color of the fall leaves, and her face turns up like a flower. But what to say to her, let alone what to do, and whether she is nice or hot, a distinction made in those days. But what to say? Take a drink, by now from a proper concave hip flask, a long way from the Delta Coke bottle, with a hinged top. Will she have a drink? No, but that's all right. The taste of bourbon, cream of Kentucky, and the smell of her fuse with the brilliant Carolina fall and the sounds of the crowd and the hit of the lineman in a single synthesis. Well, from the heights of poetic brilliance to the more mundane business of bourbon theft, It's the job of the April 22nd, 2015 article in the Wall Street Journal entitled Bourbon Thefts Called an Inside Job. The article details the theft of 18 barrels. They're 500 pounds each, these barrels. 18 barrels from the Buffalo Trace Distillery and the Wild Turkey Distillery over a period of years by an alleged ring of 9 people, who also stole lots of bottles of things like Pappy Van Winkle bourbon and were caught selling them. I like the quote from the article, which goes as follows. Buffalo Trace Distillery and Wild Turkey have said that they are examining and adjusting their security protocols, I should say, when 18 gigantic barrels go missing. Anyway, that should illustrate that MarketWatch was correct. There's all kinds of demand out there which would cause people to steal bourbon, notwithstanding the lack of aesthetic appreciation by those who are stealing. But maybe there's aesthetic appreciation on behalf of those who are drinking, and even if there isn't, there's hope for others who drink too much bourbon, perhaps. Live Science, April 21, 2015, in an article by Owen Jarvis entitled Ancient Hangover Cure Discovered in Greek Texts. Now, there you go. There's some news you can use and maybe an investment opportunity. There's a series of papyrus fragments that were discovered 100 years ago, and they are from 1900 years ago in Attic Greek. These fragments have been studied, deciphered, and published on a rolling basis. Well, the most recent fragment that was published had this hangover cure in it. It's a recipe for a, quote, drunken headache, end quote, cure. That's obviously a translation. The alcohol victim would have strung together leaves from a shrub called Alexandrian Chamaedaphne. The Latin term for the shrub is Ruscus racemosus, possibly wearing the strand around the neck. So, what to do with this? Well, the article states, though people in the ancient world believed Alexandrian Chamaedaphne could ease a headache, whether the cure really worked, let alone on a drunken headache, is unknown. I would suggest that those who've been poring over the ancient papyrus contact Christina Lee, an expert on Anglo-Saxon society from the School of English at the University of Nottingham. Faithful listeners will recognize Christina Lee because we discussed an article published recently in which Ms. Lee found an ancient potion, an eye salve, in the British Museum, written in Anglo-Saxon from pre-Norman, what is now the United Kingdom, and had enough of wits about her to translate it and then send it over to the microbiologists at the University of Nottingham, who whipped up the potion, tested it on a live specimen, and found that it could kill the MRSA superbug, which is a type of staph infection resistant to antibiotics. I suggest that the University of Nottingham be sent forthwith some Alexandrian Chamaedaphne to see what they can do about that. Again, maybe a startup is in the wings. Well, let's move to our interview.
With me today is Sang Lee, the Chief Executive Officer and founder of DarcMatter, an online investment platform providing retail investors access to institutional-level private investment opportunities. DarcMatter offers issuers and investors this access through its online platform, and this provides opportunities to raise capital and to invest. Sang is a former investment banker and has significant expertise in financial regulations and structuring. He has been featured in Forbes, Huffington Post, Entrepreneur Magazine, and Fast Company, and has been recognized as a Good 100 ChangeMaker and as an under 30 CEO entrepreneur to watch in NYC. Sang has been invited to speak at the UN, the National Science Foundation, and the Council on Foreign Relations. He also serves as the president of Korean Startups and Entrepreneurs, a nonprofit organization. An audience, I should mention that on our website, www.AIMkts.com, Mr. Lee is featured in a few minutes with Sang Lee, a written interview. So Sang, I was wondering if you could give the legal context for your opportunity. The Jobs Act is a foundation stone for the entire Accredited Investor Markets enterprise, but not everybody has gone through it in great detail. Would you mind just commenting for a few minutes about that?
Yes, absolutely, Chris. Glad to be here. So I've actually worked on the Jobs Act later part of 2011, 2012, helping it to get passed, and then subsequently working with the SEC to issue the final set of rules, particularly as it relates to Title II, which was the lifting of the ban on general solicitation, which is a very complicated way of saying that private offerings prior to the Jobs Act under a certain exemption in the SEC regulations was not permitted to utilize any type of advertising. So it had to be distributed amongst a very close group of investors or only with investors with whom people had previous relationships with. With the lifting of the ban, we've seen a lot of development in the infrastructure and technology side of the business of the marketplace, whereby more and more products are becoming accessible by accredited investors, and in turn, accredited investors are becoming increasingly curious as well as keen on including alternative assets within their investment portfolios.
Okay, but to be perfectly clear, the foregoing did not apply to everybody. The ban on direct solicitation was lifted only with regards to certain people, those who are called accredited investors. And what are they?
That's correct. So accredited investors have to meet a certain net worth or net income threshold. The net income test is $200,000 for the previous 2 years with a reasonable expectation to do the same this coming year, or the net asset test, which is at least $1 million of net assets, which does not consider your primary residence.
All right, good. So these people have greater opportunities to invest in private placements, that is not public stocks, but private stocks and or private other securities. And your company provides a means for linking these accredited investors with certain opportunities, correct?
That's correct. That's correct.
So reviewing and by the way, the website for DarcMatter, www.darcmatter.com. Dark is with a C, of course, and DarcMatter is all one word. It describes a DarcMatter LP feeder model. What is that, and what problems does it solve?
So the feeder model that we utilize is actually a diversified opportunity that we can create access for accredited investors that do not have extremely high net worths. So many accredited investors are typically looking to invest anywhere from $25,000, maybe up to $100,000 a year into alternative assets. But on the other side, hedge funds and venture capital funds, or many of the other alternatives that we're thinking about, require much higher minimums, sometimes in the $250,000 to the $1 million range. The feeder structure basically packages 3 opportunities which have been diligenced and aggregates investment minimums from accredited investors and in turn invest as a single entity to the underlying issuer. This basically allows for the investor with $25,000 to have the buying power of up to $1 million because we're able to aggregate and administer those investments.
Okay, so you use the term alternatives, and you're describing a class of assets. How do you distinguish between alternative assets and traditional assets?
So DarcMatter really is focusing on the alternative security asset class. So DarcMatter as a platform does not provide direct access to hard assets such as commodities, art, wine, if you will, are some of the other investments that people are looking at. We're really looking at the security asset class, which includes direct private equity into companies, managed funds, which is our largest component, as well as fixed income products such as collateralized loans, project finance, etc. Okay,
and alternatives are something other than the traditional public securities and the stock market.
That's correct.
Okay, so when we talk about alternatives, we're talking about that, and you are connecting accredited investors with the securities type of alternative assets. And you were talking with regard to the DarcMatter LP feeder model with connecting accredited investors with the securities, the alternative securities that are presented by, say, hedge funds. Well, what about private equity? That too?
Yeah, absolutely. So private equity is a broader asset class, obviously, of which venture capital is a subsection. Private equity funds and venture capital funds are a highly demanded alternative asset that investors are looking for currently.
Okay, so this allows smaller accredited investors to play with the big boys, as it were. What do the big boys think? Do they like this?
I think in terms of the actual capital allocation, obviously there are limitations because these structures are specially created for investors that have smaller buying minimums. I think what's going to be very interesting is that this market has effectively never been utilized by many private issuers. So private equity funds or hedge funds typically do not chase the $25,000 to $50,000 investor. What we're going to see as the marketplace evolves is true market dynamics from millions of accredited investors that are actually actively acting in this market. And I think you're going to see more forced transparency from a lot of the fund managers and companies that typically operated under more opaque conditions.
What we're seeing here through the DarcMatter LP feeder model, and correct me if I'm wrong, is smaller accredited investors buying into an entity, which is the LP, I take it that stands for limited partnership. And then the limited partnership as a unity goes and invests in a private equity fund or a hedge fund. Is that correct?
That's correct. That's correct.
So then from the hedge fund's perspective, they're dealing with a single investor.
That's correct. So there are several considerations which all kind of fall under the umbrella of look-through provisions. So there are certain regulatory constraints on how special purpose vehicles can be structured. That's why we create diversified opportunities. We don't use these structures to invest into a single opportunity, but 3 opportunities. And the LP itself is managed directly by DarcMatter. It's not administered by the underlying investors.
Okay. And what does DarcMatter then have to do in its management role once the investment is made?
So DarcMatter is very akin to a fund administrator at that point. Information that we receive from the underlying opportunities will be distributed back to our accredited investors. If there are any distribution of profits, we also manage that flow of funds as well to the extent that the partnership permits for it. And we effectively manage signing authority on behalf of the accredited investors as well.
All right, but isn't it true that some hedge funds, perhaps, or some of these other larger institutionally oriented alternative assets sometimes sometimes impose capital obligations on investors, or having made distributions, ask for some of those distributions back? Mm-hmm. And then what happens then in your scenario? Or is that something you avoid at the investment stage?
Right. So since the minimums are much smaller, we do feel that the mitigation of risk on the capital commitment side does need to be kind of handled up front. And in that case, what we effectively do is we actually draw down the investments all day one, and we hold it with a third-party manager, which effectively holds the capital in place for the capital call commitment as they come for private equity investments most particularly. Regarding reinvestments of distributions, that's really a transparent model whereby we let investors know that sometimes the discretion is not really within our power, and it's really up to the accredited investors to decide whether or not they would like to have the manager having that liquidity invested at their discretion.
All right. So, I mean, there have been periods of time in recent history, although perhaps not, over the last year, but recent history, where hedge funds have been, crazy performers. And one can understand why an accredited investor would want to get in on that. But let us say, we hit a period of time where hedge funds aren't doing too well. The accredited investor has purchased a limited partnership interest in this vehicle and wants to get out. How does it do that?
So the LP acts as a aggregator of the 3 opportunities. So the redemptions are done either on a semi-annual or annual basis, where we make an offer to the accredited investors. In order for accredited investors to get the return of their capital, there does need to be a minimum acceptance, i.e., in order for us to redeem from a hedge fund, we may need to ask for a minimum of $500,000, let's say. In that case, $500,000 worth of commitments from the accredited investors all need to sign up for that redemption. An individual investor with $25,000 of investment, unfortunately, cannot redeem their own stake. But when we do make an offer, if that situation, Chris, that you were talking about, holds true, whereby the market has kind of turned against a specific manager, it'd be reasonable expectations that most accredited investors would like to pull out.
Okay. Okay, so the accredited investor doesn't have necessarily greater liquidity than an institutional investor would have. That sounds a lot like what institutional investors have to contend with, although they would be investing enough that they could unilaterally leave when they are permitted to.
Yeah, that's correct. I mean, even if you're, considering a larger fund-to-fund type investments, that kind of limitation always holds true. It's really not the premium that's associated with alternative investments is actually the lack of liquidity. And the reason a lot of accredited investors are looking into it is because of that premium. So for us, our real core competency is to provide access and transparency, not necessarily, direct liquidity into the product, which may be degrading into its returns if we are able to provide that.
Well, access and transparency is something ordinary accredited investors, that is smaller accredited investors, simply do not have. You're introducing them to an entire playing field that they could not gain access to before. So how does DarcMatter make its money?
So the feeder models themselves are very similar to a mutual fund, if you will, with a much lighter fee load. The feeder fund charges 50 basis points per year, 0.5% a year on administrative fees, and a 1.5% distribution fee. So when we distribute capital back to our investors, we charge 1.5%. On the flip side, if a company has a direct offering of securities to basically sell to our ultra-high net worth individuals, the issuer pays us $2,500 a month. The feeder funds themselves are very similar to mutual funds with a much lighter fee load. The feeder funds have a 0.5% administrative fee per year and a 1.5% distribution fee, which is paid on monies that are returned to our investors. Issuers that are looking for higher net worth individuals that can potentially invest up to hundreds of thousands of dollars into their investment opportunity pay a subscription fee to be on the platform of $2,500 a month. Investors do not have a fee load for accessing our opportunities, only when they actually invest into the feeder model.
All right, thank you for clarifying that. Well, let's talk then about the market in general. And again, I refer the listeners to your website and to the writings appended to it, and to the article that's on AIMkts.com that involves you. You noted in one of those writings that the compound annual growth rate of alternatives, and I think you're talking about alternative securities, from 2005 through 2013, over that 8-year period, which included the financial crisis, was 10.7%. That sounds all right. While the compound annual growth rate of traditional investments in the stock market over that same period was 5.4%, so roughly double. My immediate question then is, or my immediate questions are, how does that contrast compare to the similar comparison before that period, and do you expect the current rate difference between alternatives and traditionals to continue into the next period?
Right. Yeah, absolutely. I think one of the primary drivers in the difference, there's academic research on it as well, is actually the illiquidity premium of the product, which basically means that many products that investors are able to access today are laden with a fee load that basically deteriorates much of the returns. And that is estimated to be about 3% in any given year. So if you add the 3% there, you're actually much, much closer. So you're looking at an 8.4% CAGR on traditional investments, or the flip side is you take away 3% from the CAGR of the alternatives, which makes it 7.7%. So you kind of can tell what the liquidity premium is there. If we're talking about earlier periods, I can't say that there's huge amounts of readily available data, but one of the kind of beacons for the alternative investing universe is always the Yale endowment model, whereby they have a much more activist approach to their investments. But if we're looking at the period of 10 years prior to 2003, all of their kind of public equity type investments are in the, mid single digits to low double digits. And if you're looking at their private equity investments, they're in excess of 36% for 93 to 2003. So if we're looking at kind of one of the benchmarks for alternative investing, I think that's a good place to start, which basically really highlights what the alternative investment class can do for a portfolio.
So tell me if the following sentence makes sense. If you want to play in this game, if you want to participate in the DarcMatter LP feeder model, and you want to win, well, you've got to be prepared to buy and hold for a period of time. You cannot be expecting to have access to those funds, this year or even next year necessarily. You must buy and hold and try to gain the upside that private equity and hedge funds get from purchasing illiquid assets, holding them, or maybe even managing them until they become much stronger assets. You think that's correct?
I think there's a huge argument definitely for stable, patient capital, and I think that's across all market classes as well. We've seen that with the Warren Buffett model as well in the traditional investments, whereby a lot of activist investing, it's hard to generate a above market return only because every time you trade, you're basically eating away at your fees as well. I think in the alternative asset class, it's a very similar model, but whereby the structure of the actual investment prevents you from doing things that could potentially harm yourself. Whereby you're looking at the fundamentals of a business model, its managers, and the core competence of generating long-term returns over time by a specific thesis or by hedging risk. And that's what I think people are really looking for in alternative assets, as opposed to necessarily 2, 3x, in the traditional marketplace.
Well, okay, well, let's finish with due diligence. We've had a number of platforms on here. Each one claims, with more or less insistence, that it provides a certain kind of due diligence. What are the due diligence issues with regard to the assets you guys deal with that are important to consider, and how do you address them?
I think one of the things that we really find important is transparency and information. I think there is a specific component of the model whereby people obviously have different perspectives on how to generate alpha.
But wait a minute, you just said generate alpha. Now I know what alpha is. Would you mind quickly defining that?
Sure. So alpha is returns above and beyond the market return rate.
So beating the market.
That's correct.
I'm going to go on. I'm sorry to interrupt.
And no, and I mean even including the alternative assets into your portfolio is effectively over a long period of time to be able to generate higher returns or better risk-adjusted returns. For us, we really focus on the amount of information that is presented to investors and in what fashion it's going to be presented in. And our belief of the marketplace is that there will be effectively a lot of commoditization and crowdsourcing of due diligence as the traditional stocks and bonds markets do when there's the infrastructure in place to do that. So our core due diligence is a 40-point checklist, which is very similar to a broker-dealer's check. But one thing we do not speak to is the investment worthiness of the opportunity. So we won't rate opportunities. We won't tell people that this is better or that's better. I think that's exactly what a marketplace should evolve into. But our vision for the company is to become a cloud-based infrastructure for the entire alternative capital markets, as opposed to the best picker, if you will, in the industry, which I think is very difficult to do on its own.
Yes. The last question about due diligence then is, have you dinged any opportunities? Have you refused to put them on your site because the information was too sparse or not transparently presented enough?
Absolutely. Absolutely. That happens all the time. Sometimes funds are just a little bit too early, or they're just not prepared in terms of the comprehensiveness of the information. Obviously, kind of the most comprehensive document that issuers can provide us is the PPM, which is the private placement memorandum, typically prepared by legal counsel, and is a full disclosure of the risks and returns and rewards of an investment opportunity, which is kind of the holy grail of documents. But if we're looking at other opportunities that may be too early on, we've passed on many of them.
Well, Mr. Sang Lee of DarcMatter, I want to thank you for coming here and talking about the DarcMatter LP feeder model and for your other thoughts concerning the market.
Thank you, Chris. It was a pleasure being here.
You've been listening to Accredited Investor Markets Radio. I'm Christopher Cahill. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.